Good morning, and welcome to Wall Street Signal, your calm and data-driven guide to the U.S. financial markets. As we begin a brand new trading week, investors are preparing for what could be another pivotal stretch on Wall Street, with futures steady, economic data in focus, and the Federal Reserve back in the spotlight. This morning's pre-market tone is cautiously positive. Futures are mixed but stable, inflation pressures are easing, and earnings momentum remains healthy. At the same time, traders are balancing optimism about growth with ongoing concerns about valuations, interest rates, and global uncertainty. Let's take a closer look at what's setting the tone before the opening bell. From futures action to key data, the Fed's outlook, and the sectors to watch as the week begins. U.S. stock futures are pointing to a quiet but constructive open as investors digest last week's strong performance and look ahead to fresh economic data. As of early Monday morning, S&P 500 futures are up around 0.2%, Dow Jones Industrial Average futures are modestly higher, and Nasdaq futures are slightly in the red, reflecting mild profit-taking in the technology sector. After several weeks of steady gains, investors appear content to pause and reassess. The S&P 500 enters the new week near its recent highs, while bond yields have stabilized around 4.3%, helping to support equities and risk sentiment. Asian and European markets traded mixed overnight, with investors overseas also watching U.S. inflation data and central bank commentary later in the week. The dollar index is slightly softer, oil prices are holding near $85 per barrel, and gold is trading around $2,350, all suggesting a stable tone heading into the new session. The message from futures this morning is clear. Markets are taking a wait-and-see approach, but optimism remains intact, as investors anticipate a data-heavy week that could reinforce confidence in a soft landing scenario. This week's macroeconomic calendar is packed with important updates that could shape the market's direction. The spotlight will fall first on inflation data, including the Consumer Price Index (CPI) and Producer Price Index (PPI). Economists expect both reports to show continued cooling in price pressures, offering further evidence that the Federal Reserve's tightening campaign is having its intended effect. If inflation data comes in softer than expected, it could strengthen the case for rate cuts in the first half of next year, a scenario markets have already begun to price in. Alongside inflation, we'll see fresh readings on retail sales, industrial production, and housing starts. These will help investors gauge the strength of consumer spending and business activity as the year draws to a close. So far, the data suggests that the economy is slowing, but not stalling, an outcome consistent with the Fed's goal of a controlled cooldown rather than a contraction. Labor market data will also be watched closely, with jobless claims expected to edge slightly higher, but remain historically low. A gradual softening in employment conditions supports the idea of easing inflation without triggering a broader downturn. Taken together, this week's data will serve as a key test of the soft landing narrative, one that continues to underpin bullish sentiment across Wall Street. Turning to the Federal Reserve, policymakers enter this week in a quieter phase, but the market remains highly sensitive to any comments from Fed officials. The consensus view is that the Fed will hold rates steady for the remainder of the year. Chair Jerome Powell recently emphasized that while inflation is moderating, the Fed wants to see consistent progress before considering rate cuts. Futures markets now imply that the first potential rate reductions could arrive sometime between April and June of next year, depending on how inflation and employment data evolve. That expectation has been a key driver behind the stock market's resilience, particularly in rate-sensitive sectors like housing, technology, and financials. The Fed's dual mandate, maintaining price stability and supporting employment, remains finely balanced. Policymakers are likely to welcome the recent cooling in inflation, but will avoid declaring victory too soon. As a result, expect continued messaging around patience and flexibility. In the bond market, yields remain range-bound, and credit spreads have tightened, signaling improved confidence in the economic outlook. This more stable backdrop has allowed investors to focus less on policy uncertainty and more on earnings and fundamentals. Let's turn now to the sectors likely to drive market action in the coming days. Technology remains at the center of investor attention. The sector continues to benefit from strong demand for AI, cloud computing, and semiconductor products. Analysts are watching NVIDIA, AMD, and Microsoft closely for updates on data center spending and AI adoption trends. However, valuations in some high-growth names remain elevated, which could lead to short-term consolidation after recent gains. Financials are also in focus this week, particularly as large banks provide updates on credit quality and loan demand. Rising deposit stability and steady trading revenue have supported the sector, and investors are watching for signs that profitability can hold up even as rates plateau. Energy prices have rebounded slightly, and the sector could continue to benefit from steady global demand and supply discipline from OPEC+. Major oil companies such as ExxonMobil and Chevron remain well-positioned amid strong cash flow and stable crude prices near $85 per barrel. Industrials and infrastructure-related stocks continue to show resilience, supported by public spending programs and manufacturing activity. Defense and construction companies have been standout performers, and investors see continued opportunity as government projects ramp up. On the flip side, consumer discretionary names may face more pressure as spending shifts toward necessities and away from big-ticket items. Auto, housing, and retail stocks will be sensitive to both earnings guidance and consumer confidence data in the coming days. Overall, sector leadership is broadening, a healthy sign for the market's intermediate-term outlook. Geopolitical developments continue to hover over markets, though immediate risks have eased somewhat. In China, policymakers are signaling further stimulus measures to stabilize the property market and support consumer demand. Any signs of stronger Chinese industrial activity could boost sentiment in commodities and global manufacturing stocks. In Europe, inflation continues to trend lower, which has led investors to anticipate a potential pause in European central bank rate hikes. That, in turn, has supported the euro and lifted European equity markets modestly. Meanwhile, energy markets remain sensitive to developments in the Middle East. Though crude prices have stabilized, traders continue to monitor supply dynamics, shipping routes, and any new policy statements from OPEC+ members. These international crosscurrents, combined with easing inflation and a steadier Fed outlook, have contributed to a more balanced global investment landscape. As we head into the new week, the market setup appears stable but selective. The combination of easing inflation, solid earnings, and steady interest rates continues to support the bullish case. But near-term volatility is possible as traders react to incoming data. Key themes to watch this week include inflation trends, Fed commentary, and sector rotation. A consistent soft landing narrative could keep equities near their highs, while any surprise in inflation or policy tone could trigger a brief pullback. For now, futures point to a steady start, and investors appear confident that the U.S. economy remains on track. As always, staying diversified, disciplined, and data-driven remains the best approach in a market that rewards patience and clarity. That's all for today's Wall Street Signal pre-market report. If you found this update helpful, be sure to like, subscribe, and turn on notifications so you don't miss our next daily and weekly outlooks. We'll see you at the closing bell, right here, where clarity meets the markets.